So intro of myself, we'll talk about asset protection, we'll talk about some tax deductions, depreciation, tax strategies, as well as tracking profits. Now, if you have any questions at all throughout the presentation, then please feel free to let me know. I'll be more than happy to answer any questions or anything like that. This will be recorded, so if you miss anything or if you couldn't hear anything like that, then we will make sure to report this. For those joining, just a few housekeeping items. If you are not speaking, we do ask that you mute yourself. Sometimes some of the background noise can be a little distracting. But with that being said, who am I? My name is Jeff Badu. I'm a licensed certified public accountant. I went to the University of Illinois at Urbana-Champaign, got a bachelor's and a master's degree in accounting. I'm what's known as a parallel entrepreneur, meaning that I own and control multiple businesses that run along with each other. So I can basically take two businesses and simultaneously run them, and basically they do similar things. I'm also a wealth multiplier. I help people build wealth. So not only am I a tax accountant or a tax advisor, I'm also a wealth multiplier. We take the services a little further than just the taxes or anything like that. I'm the founder of Badu Enterprises, LLC, which is the parent company of Badu Tax Services and Badu Investments, LLC. Badu Tax Services is a tax firm that specializes in tax preparation, planning, and representation for individuals and businesses across all 50 states in the U.S. And Badu Investments is primarily a real estate investment company that invests in multifamily residential properties, primarily on the south side of Chicago. So those are my two core key companies that I run and operate. And there's a reason why I go through that specifically, because I do think it's important to make sure that you're protected. You have entities around your name and all that good stuff. One thing about me is I'm very passionate when it comes to financial literacy. So I love this topic a lot. It's very near and dear to my heart. And this is why I'm here, teaching you guys this topic about real estate. Real estate is in my blood. So I invest in real estate every single year. We buy a lot of properties. We primarily hold. We don't really sell. We have sold a few, but we primarily buy and we hold the properties. And my tax firm essentially helps a lot of investors when it comes to the tax side of real estate investing. So with that being said, let's get into asset protection. Hopefully you guys can see my screen okay. If you can't see it, please put in the chat box. Let me know, because this is very critical information. So when it comes to asset protection, it's very important that as a real estate investor, before you own your first piece of property, you have to make sure you protect yourself. There are a lot of people out here that put their properties in their personal names for whatever reason, whether it's because it's residential and they don't know they can transfer. Well, the good news is today, let me make sure. The good news is today we'll be going over some topics, that allow us to talk about. We'll be going over some different ways that allow you to essentially invest in real estate the proper way. So the different types of entities, we have LLC, which stands for Limited Liability Company. We have S Corporation, and then we also have C Corporation. Those are the three real ways to hold real estate or to buy real estate. LLC I like just because of the fact they are LLCs, just because of the fact that it's very simple and it also provides you the asset protection that you need. And really quickly, just a few housekeeping. I think we have some more people joining. When you join, please make sure you turn on your audio in order to be able to hear the presentation. If you miss any part of this, this will be recorded, and we can also schedule a follow-up. So just for the folks who can't hear or anything like that, or who can't see the presentation for whatever reason, just wanted to lay those housekeeping items down. But LLC, S Corporation, and C Corp, your real estate should be held in an LLC because of the thing called the built-in capital gains tax, which you want to avoid at all costs. We'll talk about that deeply in a second, but that's part of the reason why real estate, that's one of, if anything, that's like the number one reason why you should own real estate in LLC as opposed to a corporation. So just wanted to point that out. Now, why your real estate should even be owned by an entity or an LLC? The first one is to enhance your credibility. Anytime you're going out to, let's say you're a wholesaler, or let's say you're a seller who's trying to sell your property, then the buyer's probably going to take you a little more serious if you have the words LLC, INC, something next to your name. It just proves that you're truly in this as a business as opposed to your personal. So it enhances the credibility that you have as an investor. And also, number one is to protect your personal assets. So if somebody sues you or sues the building, they can only claim the building. They cannot claim, or whatever's in the LLC at the time, they cannot claim what you have personally. So that's the number one reason why we want our real estate in an LLC or an entity is to protect our personal assets. If somebody sues you, they cannot claim your personal assets. So just wanted to point that out. Lastly, it provides you easier access to capital. So essentially, if you're applying for a mortgage or if you're applying for financing, you basically are required to have LLC, INC if you're looking to get the mortgage in the company's name, or if you're looking to get the property in the LLC's name. You have to have some type of entity for them to put it in an actual business, give you a business loan essentially. So those are the three reasons why it should be in an entity. Now, why an LLC? The LLC avoids the built-in capital gains tax. Essentially, when you're looking to sell your real estate or transfer ownership of the property to another party, and it's in a corporation, you could get an unnecessary capital gains tax that you have to pay because of the way corporations are structured legally. If it's in an LLC, there's no such thing as a built-in capital gains tax. You only trigger the capital gains tax when the property is actually sold, not transferred or anything like that. There's also no FICA or self-employment tax with an LLC that owns rental real estate, at least. So you don't have to pay the 15% Social Security or FICA tax. Another thing is very easy and low maintenance, meaning that it only costs about $150 to set up an LLC in Illinois, and also to renew it, it's about $75. You don't have to have bylaws, stockholder certificates, and all this other stuff. You just have to make sure you renew your LLC and perhaps keep an operating agreement on file. I think that would be good. Now let's talk about the Series LLC a little bit. Series LLC is great because you can own one big LLC as a parent company, and you can have cells under that one LLC, or subsidiaries they call it. So it's nice because you can have one big LLC, and then you can have sub LLCs under that. It's good because it's a simple structure. You buy a property. The goal here is every property you own should be owned by an entity of some sort, or should be operated by an entity of some sort. So with a Series LLC, you can have one LLC as the parent, and then you can have sub-cells or sub-LLCs that the parent company owns, essentially. The nice thing with that is they're separate legal entities according to state law. So each cell in the series is like its own LLC. So it has its own tax ID number, can have its own bank account, all that good stuff. Some banks don't like Series LLC, but there are a few banks that do allow you to have different bank accounts for the series. Now, here's why you should not do a Series LLC. if you want maximum asset protection, is because Series LLC is not recognized by federal law. And by the way, I am not an attorney, so anything that I say is not legal advice, simply giving you best practices when it comes to structuring real estate. But essentially, a Series LLC, if a tenant sues you, tenant slips and falls, busts their head or whatever, and you own a Series LLC and one of the cells owns one of the properties, then essentially, if it's state law, they can sue the cell. They sue the cell of the series, and they would only be able to get the property that the cell owns. However, if they take this all the way up to the Supreme Court at the federal level, then you could lose your entire Series LLC or all the assets in the entire series, because Series LLC is not recognized by state law. I'm sorry, by federal law, only by state law. As a matter of fact, Illinois was the first to start the Series LLC. Not every single state has the Series LLC adopted, and that's why this cannot be recognized on the federal level. So that's why Series LLC is not recommended when you're holding real estate, because tenants, some tenants are savvy. They might get they might get OJ's attorney, who knows, and take you all the way up to the Supreme Court and sue you and claim ownership of all your properties that's in that Series LLC. So for me, I like maximum asset protection. Every property is in its own separate LLC, no Series LLC whatsoever. If you're flipping, it's fine to have series because those are short-term by nature anyway. Now, for those that bought a property in their personal name, or they did a residential loan, maybe they did an FHA. With an FHA loan, you're allowed to buy a property and, up to 4 units, live in one unit, rent out to other units. So let's say for whatever reason you bought the property in your personal name. This is how most people buy real estate. You bought it in your personal name, and you're like, okay, well, I don't want to get sued, or I don't want to lose everything. Well, what you can do is what's called a quitclaim deed. A quitclaim deed allows you to transfer the property into an LLC, or essentially transfer the beneficial ownership into an LLC, and that allows your LLC now to own that property. Your lease is in the LLC's name. Your payments are being made to the LLC. Everything is being done in the name of the LLC. That way, if the tenant sues you, they can only claim what's in the LLC, not you personally. You have to make sure you keep your bank account separate and all that good stuff, separate QuickBooks files, all that stuff. But it is possible to transfer even an FHA, Federal Housing Administration loan that you got you're not transferring a loan, you're just transferring a property itself. The reason why banks don't really care about this is because you're still on the hook no matter what. Whether you put in an LLC, corporation, whatever it is. But you can transfer, or you can add an LLC to the title of the property, in order for the LLC to be the one that owns and manages the property. Now, there's a thing called the due on sale clause, which a lot of people get scared of. That's basically the bank shutting down your loan for whatever, just because you transferred ownership. It is possible, but it's very, very unlikely for a bank to trigger due on sale clause, because you're still on the hook for the loan anyway. They don't care who's paying the bank, as long as they're receiving their payments on time. Now, the moment you stop paying, that's where the issues happen. So just to recap, make sure your real estate is owned by an LLC. It's fine to buy it in your personal name. Try to avoid it at all costs. But if you have to, just because it's your first property, or you want to do the house hacking strategy, that's fine. Just make sure you transfer it at least after closing. And if you're doing a commercial loan or a residential loan that allows you to have an LLC, then have the LLC own it. So moving on is the land trust. And if you guys have any questions at any time, please feel free to chime in. We will leave about 5 to 10 minutes at the end for questions. But I know this is a lot of stuff. This is recorded, so you will have an opportunity to dive deep into this. Even if you need the slides, I can even send them to you. So I don't want anybody to miss anything or feel like they're being overwhelmed with the information. So now, land trust. If you want an extra layer of protection, if you want O.J. Simpson type protection, then you want to make sure you have a land trust. You know, a land trust adds another layer of asset protection. So the LLC only protects what's outside of the LLC. It does not protect what's inside the LLC. It does not protect the property itself. If a tenant slips and falls and busts their head and sues the LLC, they can still get the property. How do you avoid that? Is you set up a land trust, and you have the property owned by a land trust from the initial phases. You know, so on the title and a contract would state, you know, the land. It's usually Chicago Title Land Trust 1, 2, 3, 4, 5, 6, 7. So the property would be owned by a land trust. What this allows you to do is you cannot sue in the state of Illinois and other states. You cannot attach a judgment to a land trust. So with this, you know, if you just had an LLC, the tenant can sue the LLC and claim the property. With a land trust, the tenant cannot claim the property. So that's very important to note, is with a land trust, if a property is owned by a land trust, you cannot attach a judgment to the land trust. You know, so just something to note right there is you cannot attach a judgment to a land trust. So if you want to create that, and remember, if you do the land trust, it only protects the property itself. So the reason why we do an LLC and a land trust, the way we structure it is we have the real estate owned by the land trust, but the LLC as the beneficiary. Because if the LLC is the beneficiary, then, you know, the tenant can sue the land trust and not get anything in the land trust, but they can try to sue you personally. And if you have an LLC that was managing everything, then they cannot sue you personally. They would have to sue the LLC. And of course, the LLC is the one that has the land trust. So they cannot touch the land trust, and they cannot touch what's outside the LLC. So you basically create inside and outside protection with the land trust. And you also create privacy. So with the land trust, nobody knows who owns it other than Chicago Title Land Trust 1, 2, 3, 4, 5. So if you want to protect your assets, then land trust is definitely the way to go. So let's move on really quick. Remember, if you guys have any questions, land trust or anything, please feel free to chime in. Of course, you want to consult your attorney, your advisor, and all that good stuff before you do any of this stuff. However, these are just best practices that are usually best used when it comes to real estate. So let's move on to the tax component. We got about 30 minutes left or so. Now, as a real estate investor or business owner, right, you're allowed to claim tax deductions. A tax deduction is simply an offset, something that helps reduce your taxable income. You know, so it's not a tax refund. It's not money you're getting back from the government or anything like that. It's simply a reduction of your taxable income. So if you make $10,000 income gross rent on a property, you get to deduct things in order to reduce the tax that's $10,000. You know, so if you're doing rental real estate, you're usually use the Schedule E of your 1040 to record your income and expenses of your rental real estate properties. It doesn't matter if it's in an LLC, you're still going to use the Schedule E. Now, if you have a partnership, then you have to file a 1065 partnership tax return, which ends up on your Schedule E. If you're doing flips or wholesale, you know, flips is Schedule C or D. If you're doing one-time flips a year or 2 times flips a year, then you use Schedule D. If you're doing this as a business, you know, if you're in a business of flipping, then you're using Schedule C. The difference between the two is about 15% extra taxes. Schedule C, you're paying a FICA or self-employment tax. So if the IRS does not really like flippers, they like people who like to buy properties and hold it for a long time. You know, so that's just something to note there. Now, as far as what you can write off virtually every expense tied to the building. Mortgage interest, property taxes, repairs, you know, certain types. We'll get into that in a second. Maintenance, utilities, mileage, travel, depreciation. Every time you travel to the property, you should be writing that off, because for every time you drive to the property, even if you live there and it's a rental property, you should be writing that off because you're visiting your rental. You know, so you should be tracking your mileage every time you go to the property, not from the property. If you live there, you cannot take deduction from the property. But if you are going to the property and you live there, you can take the mileage deduction. If it's a pure rental, then every time you go, every time you come, you should be writing off those miles as a tax deduction. So Schedule E is what you're going to use to deduct your expenses. Always keep track of this throughout the year. The last thing you want is an audit that you're not prepared for. So just something to note there. Now let's talk about the repairs. So certain repairs are not able to be written off in full. Certain repairs you have to do what's called depreciation. And when you buy the actual building, you have to depreciate the building. So if you bought a $100,000 building, you simply take $100,000 and you divide it by 27.5, and that's essentially what the deduction is going to be. So depreciation is simply the ability to write off, essentially write off the cost of the building over time in certain repairs. For residential properties, it's 27.5 years. For commercial properties, it's 39 years. Most of my clients, this is what helps them reduce their taxable income down to just about zero. Most of my real estate clients don't pay any taxes on the real estate, or at least income taxes, because of depreciation. So you're taking a purchase price or whatever the building costs minus land. You cannot depreciate land, and you're basically deducting the cost, divided by 27.5 over that many years. And here's a nice thing with some banks. When you're applying for bank financing, some banks will allow you to add that back to your income. So if you took a $10,000 a year depreciation deduction, they'll add that back to your income even though you got a tax benefit for it. So if your income was $30,000 taxable on a tax return, it would be to the bank it would be $40,000 because they can add back depreciation. So it's a beautiful strategy. Now you might be wondering, well, if I buy a new roof or if I buy new appliances, I don't want to be doing this over 27.5 years. I want to accelerate the depreciation. Well, thank goodness for the new tax law. It allows us to depreciate things faster. It's called Section 179 of the Internal Revenue Code. Section 179 now applies to rental real estate. So things such as roof, flooring, appliances, hardwood floors, things of that nature, you get to deduct in full in the first year. What you have to make sure you do is you have to make sure that you track it on a consistent basis. So you have to make sure that you track it essentially every time you buy something, or every time you spend money on something, you want to make sure that you track that expense. So just something to be aware of. What you might want to do is you might want to invest in a cost segregation study. Basically, an engineer can come out to the property and go and inspect every single item and be able to tell you, hey, this can be accelerated, depreciated quickly, and this you might need to wait a little bit. The good thing here is since it's depreciation, the bank usually adds it back to your income. So you're not like, some people are like, oh, I want to look more, financeable. Well, this is not going to affect your, ability to get financing because most banks that I know add back depreciation to your income. So this is a beautiful way to escape taxes over time and still be able to buy more buildings. So instead of claiming repairs, which most people do, now it's best to do it through depreciation because of the way the banks work. And as a real estate investor, we got to think from a banking standpoint and a tax standpoint. We can't just think taxes, or we can't just think, banking. We got to think from both things. So for me, for my clients, I always ask them, hey, what are you looking to do with this real estate? Like, I know you own real estate. What are you looking to do? Are you looking to buy more properties? Or are you looking for maximum deductions? Depending on the answer, that's the strategies we use, when it comes to the tax return. So we do have new accelerated depreciation rules. Now, really
Jeff,
quickly.
can you hear me?
Yes, sir.
What are other examples that can be depreciated? Can you depreciate anything that I put in the unit, such as, let's say, cabinets or countertops, things of that nature, based on the life cycle?
Yes. So cabinets, appliances, flooring, like hardwood floors, laminate tiles, the toilets, the doors, the fence around the building. Basically everything except for the actual building itself, you know. So anything that improves, and this includes buildings that you bought that were brand new, basically. Like if you bought an FHA and it was a brand new building, you can actually include that as well. So it's highly recommended, and whatever you don't use in the first year, you can just keep carrying over time. So this is one way that as a real estate investor, you can truly take advantage of the tax law and the tax code and minimize your tax liability down to pretty much zero. Does that answer your question?
Yeah, makes sense.
All right, cool. Yeah, and if you guys need any specifics or anything like that, schedule a follow-up, schedule a consultation. We can go more in depth. These are just meant to, so you have an idea, and when you depreciate something, it helps reduce your taxable income. That's the goal here, is to minimize your taxes and still be able to finance more buildings in the future. Now, let's talk about the more in depth. So, I basically showed you guys one way to escape taxes. When you buy the building, you're running it, you're owning it, you're operating it. Now, what about when you sell it? So you might be wondering, okay, well, I've depreciated so much. When you depreciate and you sell it, you have to pay taxes at a later time. So depreciation is more of a tax deferral strategy. If you want a tax elimination strategy, you got to use one of these four right here. The first one being a homeowner's exclusion. This only applies to your primary residence. So if you own a home and you live there for 2 years before the year that you sell it, right, you get to 100%, up to $250,000 of the gain. So let's say you bought a house for $100,000. Somehow 2 years later, let's say this was in Hyde Park or something. 2 years later, the building went to $350,000 and you live there. Well, guess what? You don't have to pay any taxes on that entire $250,000 gain because of the homeowner's exclusion. And if you're married, this is one part of the reasons why I encourage people to get married. If you're married, it's $500,000. So if you bought a house for $100,000, you sold it for $600,000, and you lived there for 2 years, you don't have to pay any taxes on $500,000 of income, clean cash in your pocket. That's very powerful right there. So homeowner's exclusion is one way to completely escape taxes. Now, if you rented it out, then you have to reduce some of that. You basically get a reduction on the exclusion. We do have a quick question here. It says, what was the recommendation regarding accelerated inspection? I believe depreciation or accelerated inspections. Would you suggest having an appraisal done? Essentially, I believe this is referring to cost segregation. So I do believe that you should, invest in a cost segregation study, which will force you to have an appraisal done on a house, essentially. So the appraisal gets, basically an engineer goes into the property and they go and inspect every single component of the property. That's what's called a cost segregation study. So I highly recommend it. I think it's great to invest in. So that's just something to be aware of. And for those who miss any part of this, this will be posted on YouTube. So this webinar that we're doing here, this will be posted on my YouTube channel. Just search Jeff Badu on YouTube. You'll find all the videos there. So no need, you won't miss anything. You won't miss any information. If you need more information, follow up anything, you still got time. So just bear with me. But yeah, I do highly recommend you invest in a cost segregation study. It's going to cost you some money, but hey, if you're able to accelerate the depreciation and all that, I'll be the first to admit that I rarely pay any taxes legally because of the amount of real estate that I own, the amount of investments and things of that nature. I take full advantage of depreciation, and I'm still able to get bank financing and things of that nature. So depreciation can be so powerful. So I'm glad somebody brought up a question, hopefully around that. But if it is another question, just feel free to clarify anything like that. But homeowners exclusion allows you to sell a building that you've lived in for the past 2 years and sell it tax-free up to $500,000 tax-free if you're married, $250,000 if you're single. Very nice strategy right there. 1031 exchange is when you essentially you're trading one property for another. So let's say you bought a building for $100,000, it appreciated to $300,000. You're like, you know what? And it was a single family. You say, you know what? I'm ready for multi-family. Or I'm ready for, townhomes, whatever it is, or Gary, Indiana tax sales. What you can do is you can trade that one property that's worth $300,000. You sold it, you got $300,000 or $200,000 profit in your pocket. You can take that money and essentially buy more properties and not pay any taxes on it. You can buy as many properties as you want. You can buy 1, 2, 3. The exchange applies to not just one, but multiple properties. And as long as you're trading one real estate for another type of real estate, that's what qualifies you for the exclusion. There's a lot of details in between. For example, you have to have an intermediary. You have a certain amount of days before you sell a property and buy another one. You have to identify the building, 45, 90. There's a lot of rules regarding it. Won't get into the specifics, but just understand that you can trade. If you're a real estate investor looking to continue your real estate investment journey, you don't have to sell and then buy. You can, or sell, pay taxes, and then buy. You can sell, not pay taxes, buy, and then continue to doing it. And guess what? When you pass away, you get what's known as step-up in basis, meaning that all your properties will be, the basis or the cost of the properties get marked up to the fair market value. So your beneficiaries can then sell it, and you would have completely escaped taxes, assuming you don't have an estate tax, which is way beyond the scope of this presentation. But 1031 exchange, as it's in its name, it allows you to exchange one property for another and not pay any taxes. Now, opportunity zones, the hottest thing since the cannabis industry and Bitcoin. Opportunity zones, very hot right now. Essentially, you're doing a 1031 exchange, but you don't have to trade real estate for real estate. It can be a stock that you sold, and now you're looking to reinvest the profits into something. You'd have to, if you want to escape taxes on that profit, or let's say you sold a building and you're like, you know what, I don't want to do 1031 because it's so complicated, has all these rules and all that. I want something a little simpler. Well, opportunity zones are essentially underprivileged or underserved neighborhoods and across the U.S., such as Inglewood, in Chicago, neighborhoods that can be a little rough at times. So the government wants you to invest in those neighborhoods, so they're giving you a tax incentive. If you reinvest your profits into a building that's located in an opportunity zone and you improve that building, you don't have to pay any taxes on the profit that you use to invest in that opportunity zone. And if you hold that property until, let's say, 2025 or so, you could potentially get up to 100% gain exclusion. So this is more of a tax deferral strategy, but if you hold it long enough, or if you keep reinvesting, as long as you keep reinvesting in the opportunity zone, you can essentially avoid taxes altogether. So opportunity zones are an opportunity to invest your profits and not pay any taxes on it. Now, last but not least, charitable main trust or charitable LLC. This is the most complicated one. But let's say that you don't want to do homeowners exclusion, you don't want to do 1031, you don't want to do opportunity zones. You just want a nice way to sell your real estate tax-free, or virtually tax-free. Or you still want to hold the real estate, but you don't want to incur the tax burden because you fully depreciated this property. You've accelerated the property down to its bare bones, basically, and you don't have any more depreciation to claim. What you can do is you can essentially, let's use this example. So you have a building you bought for $100,000, and let's say in the year 2010, and now it's worth $600,000. You're like, there's no way I want to pay $500,000 in taxes. I'm sorry, pay taxes on $500,000 in gain. So what you do is you set up an LLC, and you basically transfer the rights of the LLC or the building to the LLC. You're 100% owner of the LLC, and you're also the manager. What you do is you identify a charity that you like, hopefully, and you give 99%, up to 99% of the ownership of that LLC to a charity. What this does is it creates a tax deduction up to about 90%. It's usually discounted. So you just basically got a tax deduction of over, let's just say over $400,000. You know, you donated a building worth $600,000 to a charity where you kept 1% of the ownership, and you're a managing member, meaning you control 100% of the building. You know, so powerful way to control the building and give up the tax burden to a nonprofit, which of course is a non-taxable entity. You know, so you're getting a tax deduction up front, and then let's say you keep the property. Any profits that are made on the property, 99% of the tax burden goes to the nonprofit, and 1% goes to you. You know, you can take out a loan. You can basically take out a loan on this property, where it's coming in your pocket essentially. So let's say you get a line of credit at about 80%. You know, so let's just say you took out $400,000 loan. Let's just say hypothetically, you know, you were conservative. You took out a $400,000 loan, and the bank is giving this to you. It was a HELOC or whatever it was. You know, you can take that $400,000. You yourself can spend that $400,000 because you're the manager of this LLC. You know, and you get to control what happens in the LLC. So this is one way to control the income and everything in the LLC, but have the tax burden go to a charity. Now you might be wondering, why in the world would a charity want this? Well, you just gave them a building worth $600,000, and you're legally obligated by the time you die to pay back that $600,000, whatever it's worth at the time. So what some people do is they set up a life insurance policy, where the death benefit of, let's say they set up a death benefit of $1 million, and $600,000 is designated for the charity or the bank or whoever has the money at the time. $600,000 goes to the charity, $400,000 goes to your family. Boom, you just did 99% tax-free strategy, where you still kept the building. You know, you had a life insurance policy that paid off the loan, that paid off the charity, that paid off everybody, and you were basically pocketing all the cash while you were still alive. Oh yeah, this can be passed down up to 3 generations. You know, some very, very powerful strategy. So you don't have to, at the time of death, you don't have to pay the nonprofit the $600,000. You can just pass the 1% that you own to your son or your kid, and you can pass it up to 3 generations. And then when that third person dies, by that time your money would have probably grown to like $5 million. You know, and you're still only owing this charity about $600,000, whatever the fair market value is at the time, depending on the assets that are in that in the charity or in that LLC. So very powerful strategy, very complicated, so many components of it. You know, we usually add life insurance to it to make it, you know, to protect your interests a little bit. So those are the 4 ways to sell real estate tax-free: homeowners exclusion, 1031 exchange, opportunity zones, and a charitable remainder trust or charitable LLC. Last but not least, let's talk about QuickBooks. QuickBooks allows you to track all your expenses. Remember, documentation is key. All these things might sound great to you, but trust me, if you don't document this stuff, and if you're not keeping track of your expenses and the income, the IRS, when the IRS audits you, you know, if the IRS audits you, man, it can be big time trouble. So please keep your receipt, everything. If you did a cost tag study, even whether an engineer did it or you did it, the proof to show this is how much I spent on a roof, this is how much I spent on appliances, you know, this is the date that I bought it. Like, make sure you keep track of all that, because these sound good, these sound beautiful, but they can only be properly executed if and only if you document it correctly. You know, so just want to point that out. These are great strategies. You know, I think you should implement them. So just as a recap of what we went over today, we talked about asset protection, why you should protect your real estate in an LLC and also a land trust. We talked about some tax deductions. We then talked about the ability to sell real estate tax-free using the 4 strategies identified. And then last but not least, we talked about a way to track it by using something such as QuickBooks. With that being said, I'll open up the floor for any questions, comments. We still got about 7 more minutes for Q&A. You know, thank you guys for joining. For those that need to log off or anything like that, please feel free. This will be recorded. But this is a great time now to take any questions. So I'll take any questions at this time. So we'll leave about a minute for a question to be asked. Any questions? You can also type in the chat box too. So you can feel free to ask your question in the chat box, or you can speak your question. You can feel free to unmute yourself or anything. You know, good thing is this will be recorded, so you will have this recording. It will be posted on the YouTube channel. You simply search my name, Jeff Badu. I have a YouTube channel, and this will be on there. If you need a follow-up, please feel free to contact me directly. Reach out to me. Yes, sir.
Hey, Jeff, can you hear me? Hey,
yeah,
quick
I can hear
question.
You.
All right, so, okay, this is Des. Hey, I set up an LLC, but I have another business entity in it as well, but I just bought some real estate in this LLC. Will that get tricky during tax time, or if I have all my receipts, I'm good? What would you say? Or should I just start getting separate LLCs for each property?
Got it. So just to clarify, does this business own other things outside of real estate?
No, it doesn't own anything else.
Got it. Okay. I mean, it's fine to have an LLC that owns multiple properties. I've seen it before. It can be done. It's fine. As long as you're keeping the books and records separate for the properties, you'll be fine. You know, the max you want to do on a property is 5 properties in an LLC. Anything more than that, then you're stepping into a danger zone. But as long as you have 5 or less in one LLC is fine. Just keep your books and records separate for each and every property.
Okay, got you. And so you would recommend setting up, if I buy another property, now I want to put an LLC, probably just set up a whole new LLC for it, and then put it all under one umbrella, big time LLC, or?
Overall, maximum asset protection is better, meaning every property is owned by its own LLC. So, there's no series LLC, no big parent company. We're talking every single property owned by its own LLC, essentially. And if you want to take it a step further, have it owned by a land trust and have the LLC be the beneficiary of the land trust. Each property would have its own land trust, and each property ideally would have its own LLC as well.
Okay.
Yes, sir. Any other questions before we log off here?
Is there any additional tax benefits of having an LLC series versus just having an LLC? Or is it just for protection?
Yeah, so LLCs are strictly for protection. To be honest, you get really the same tax benefits whether you have the property in your personal name or an LLC. It's more about a protection thing. And a series LLC, you only file one tax return. If you're doing multiple LLCs, then you might have to file separate tax returns for the separate LLCs. The only reason why, or one of the tax reasons why you would want to have an LLC is because you can do things like board meetings. You can go to Vegas, the Bahamas, use these more creative tax loopholes where you can have up to 4 board meetings a year in your LLC or corporation. You can go to Jamaica, Bahamas, Vegas, and still be able to write it off as a business expense because you had a board meeting. So like that. If anything, that's one reason to make sure that one tax reason. Legally, you should always have your LLC, but if you want more tax advantages or more tax reasons, it makes your expenses look a little more legitimate because you have an actual business.
Okay.
Does that answer your question?
Yeah.
Excuse me, Jeff. I have one question.
Yes, sir.
Do all these different, like the LLC and the land trust, does that change from state to state, or is it across the board federally?
I'm sorry. Can you repeat the question?
I had a question, man. Does the class run to December the 12th?
Yeah. I'm sorry. I think Perry. I just need Perry to repeat his question really quick.
I'm sorry. So does the land trust and the LLC laws, do they run different state by state, or is it across the board federally?
Yes. Land trust is state by state, but most federal
Okay.
recognizes land trust. You know, does that make sense?
Yeah, that makes sense.
Got it. Yeah. So yeah, land trusts are definitely like
Can I use your
the
opinion?
judge would not overrule you if you had a land trust. I mean, they could. There are ways to do it, but it's very unlikely that, you know, since the property is owned by the land trust and it's in a state, usually the state laws, you know, always win in most cases. You know, so that's why. So the land trust is going to be recognized. Now, does someone else have a question? I think viewer 23 had a question or something. All right. Well, if no questions, then please feel free to schedule a follow-up. Please feel free to check out, you know, the recording. Reach out to me. Just anything you need as far as getting your land trust or, you know, getting your real estate on board. Please make sure that you are you're following this material, because it is very important. Last thing you want is to own a bunch of real estate, pay a lot of taxes, and then lose it all to somebody because they sued you. You know, they slipped and fell and bust their head. Last thing you want, you know, we're here to build wealth smartly, you know, from a smart standpoint. So with that being said, we usually have a webinar once a month. Hopefully you guys can check it out. We do some in person. Most of it is a webinar format. But we will officially end the recording at 8:01 p.m. Central Time. Thank you guys for tuning in.